Imagine it's the 3rd of December 2001. You are a 34-year-old schoolteacher living in Buenos Aires, Argentina. Your apartment overlooks a quiet street lined with jacaranda trees. You bought it 5 years earlier with a mortgage in dollars because everyone said dollars were safe. You have $11,000 in a savings account at the local bank, money you saved for your daughter's future. Your routine is simple. You teach in the morning, grade papers at night, and on Sundays, you walk to the market with your husband. Life feels stable, boring even, the kind of boring that feels like safety. If you have ever wondered why property prices can crash even when the buildings themselves never change, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened in different countries, in different decades, under different governments, and it always rhymes with itself. And if you find value in this kind of historical clarity, subscribing takes 2 seconds. It keeps you ahead of what most people never see coming. Now look at what happened to that teacher in Buenos Aires. On the 1st of December 2001, the Argentine government froze all bank withdrawals. This was called the corralito, which simply means the little corral, a fence put up around people's own money. She could not touch her savings. Within weeks, the peso, which had been locked at 1-to-1 with the US dollar for a decade, collapsed. By June 2002, it had lost roughly 70% of its value. Her dollar-denominated mortgage suddenly cost her 3 to 4 times more in real terms, while her salary, paid in devalued pesos, bought less and less. This video is about what happens to real estate, homes, land, buildings, the very ground beneath people's feet, when an economy officially collapses. Because the answer is rarely simple and almost never what people expect. Before we go further, there is something important to understand. Real estate feels permanent. A house does not disappear in a crisis. The walls do not fall down because a currency loses value. But here is the secret key that unlocks everything in this story. Property is not valuable because of bricks and concrete. It is valuable because of what people can exchange for it. Income, credit, trust, and currency. Think of a house like a boat tied to a dock. The boat itself does not change shape when the tide goes out. But if the water level drops far enough, that same boat ends up sitting in the mud completely intact, completely useless until the tide returns. Economic collapse is the tide going out on credit, trust, and currency, leaving real estate technically unchanged but functionally stranded. The rot in these stories is never in the bricks. It is in the beams nobody can see. The invisible structure of debt, trust, and currency holding the whole thing up. This brings us to the first major pattern. In the case of Weimar Germany in 1923, hyperinflation, which means prices rising so fast that money becomes worthless faster than you can spend it, hit Germany in catastrophic waves that year. In January 1923, a loaf of bread cost around 250 marks. By November of that same year, it cost over 200 billion marks. People famously pushed wheelbarrows full of cash just to buy groceries, because carrying paper money in a bag was no longer enough. Now here is where it gets interesting for real estate, because property, unlike paper currency, held its value in a strange and brutal way. Many German landlords who had fixed rent contracts watched their rental income become worthless within months, because the rent collected in old marks could not even buy a single meal by the time it was paid. Meanwhile, people who owed mortgages denominated in old marks effectively saw their debt vanish into nothing, because paying it off became almost free. Speculators who borrowed heavily to buy land before the hyperinflation accelerated ended up owning real assets while their debts evaporated like morning mist. Ordinary pensioners and savers who held cash, bonds, or fixed contracts were wiped out completely. Their lifetimes of careful saving turned into less than the price of a newspaper. The lesson buried in the wreckage of Weimar Germany was this. In a currency collapse, debt tied to a dying currency can become a strange kind of shield, while cash and fixed income become a trap with no exit. Here is something I want you to think about before we go. Further, if you owned a home outright with no mortgage during a currency collapse, do you think you were protected or exposed? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear, and it changes everything. The answer is more complicated than most people assume, and the second case study makes that painfully clear. Consider Zimbabwe in 2008. The country experienced one of the most extreme hyperinflations ever recorded, with monthly inflation rates, at one point estimated near 80 billion%. Zimbabwe issued a $100 trillion note, a single piece of paper that, by the time it was printed, could barely buy a loaf of bread. You would assume that owning physical property, land, houses, farms, would have been the ultimate safety raft in this storm. And in some ways, it was. Landowners in Harare who held property outright did not see their land vanish. The soil was still there. The walls were still standing. But here is the twist that surprises. Most people, without buyers, without credit, without functioning banks, and without anyone having stable currency to purchase property with, real estate became almost impossible to sell at any reasonable price. Transactions slowed to a crawl. Many properties sat for years with no buyers because nobody trusted the currency enough to commit savings into a long-term asset. Owning the asset protected you from losing it. It did not protect you from being unable to use its value when you needed cash. And this is the part that textbooks rarely explain. Real estate can be simultaneously the safest thing to hold and the hardest thing to sell, depending entirely on how broken the surrounding financial system has become. Now look at what happened next in a very different setting. The United States in 2008. This was not hyperinflation. This was the opposite kind of collapse, a credit collapse, meaning the system of borrowing and lending that allows people to buy homes simply seized up like an engine without oil. Between 2006 and 2012, average U.S. home prices fell roughly 30% nationally, with some markets like Las Vegas and parts of Florida falling by 50 to 60%. Nearly 10 million American families lost their homes to foreclosure, which means the bank legally took the house back because the owner could no longer make mortgage payments. Ordinary families who had bought homes with little money down, believing prices would rise forever, found themselves owing more on their mortgage than their house was worth, a situation called being underwater. Meanwhile, large investment firms and wealthy individuals with cash on hand bought thousands of these foreclosed homes at deep discounts starting around 2010 and 2011, turning them into rental properties. Blackstone, one of the largest investment firms in the world, spent billions of dollars buying distressed homes during this period, eventually building one of the largest single-family rental portfolios in American history. The mechanism here is different from Weimar or Zimbabwe on the surface, but underneath it rhymes perfectly. When trust in the financial system breaks, prices for real estate do not fall evenly across society. They fall hardest on those who bought with leverage and panic, and they create extraordinary buying opportunities for those who had liquidity, meaning easily accessible cash, and patience. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. There's a fourth case worth pulling apart because it shows yet another face of the same beast. Japan, starting in 1991, suffered the bursting of one of the largest property bubbles in modern history. Throughout the 1980s, Tokyo real estate prices had risen so high that, according to widely cited estimates, the land underneath the Imperial Palace was at one point valued more than the entire state of California. When the bubble popped, Japanese commercial real estate prices fell by more than 60% over the following decade, and in some cases by closer to 80% by the early 2000s. But unlike Argentina or Zimbabwe, there was no dramatic single event, no wheelbarrows of cash, no overnight freeze on withdrawals. Instead, Japan experienced what economists call a slow bleed. Banks quietly kept lending to companies that could never repay, hoping property values would recover, creating what became known as zombie companies, meaning businesses that were technically dead but kept walking because banks refused to admit the losses. This dragged Japan's economy into decades of near-zero growth, often called the lost decades. Ordinary Japanese families who bought homes at the peak in the late 1980s sometimes carried mortgages worth far more than their homes for 20 or 30 years afterward. The lesson from Japan is different from the others and just as important. Collapse does not always arrive with fire and noise. Sometimes it arrives as a slow, decades-long erosion, where the danger is precisely that nothing dramatic ever seems to happen, so people keep waiting for a recovery that takes a generation to arrive, if it arrives at all. There is a fifth case that deserves its own moment because it shows what happens when collapse comes not from inflation or bad loans, but from a government simply reaching into people's bank accounts. Cyprus, in March 2013, faced a banking crisis so severe that the government, working with European lenders, imposed what became known as a bail-in. Unlike a bailout, where outside money rescues a bank, a bail-in means the bank's own depositors absorb the losses. Account holders with more than 100,000 euros in Cyprus's two largest banks lost a significant portion of those savings overnight, with estimates suggesting losses of roughly 40 to 60% of the amount above that threshold. Capital controls were imposed immediately, limiting how much money people could withdraw or send abroad, sometimes to as little as a few hundred euros per day. Real estate in Cyprus, which had been booming for years thanks to foreign buyers and tourism, froze almost instantly. Sellers could not find buyers willing to risk large sums in a banking system that had just proven it could simply seize deposits. Prices in some segments of the Cypriot property market fell by 20 to 30% over the following 2 years. The mechanism here is slightly different again, but the family resemblance is unmistakable. When people lose faith that their money is safe inside the system, they stop making long-term commitments like buying property. even if they technically still have the cash to do it. Fear freezes markets just as effectively as missing money does. Now observe what all 5 of these cases have in common, even though they unfolded in different decades and different corners of the world. In Weimar Germany, debt. In a collapsing currency became light as paper, while cash became worthless. In Zimbabwe, owning land protected the asset itself but trapped its value, because no buyers existed who trusted the currency. In the United States, in 2008, leverage, meaning borrowed money used to buy more property than your savings alone would allow, turned a price drop into a total wipeout for ordinary families, while cash-rich investors used the very same crash as a buying window. In Japan, the collapse moved so slowly that an entire generation mistook a falling tide for a temporary low. In Cyprus, the danger came not from inflation or bad debt, but from a sudden loss of trust that froze an entire market overnight. The same mechanism, different countries, different decades, same result. Real estate during collapse does not behave like one thing. It behaves like a mirror, reflecting back exactly how exposed or protected your financial position was before the crisis hit. The building does not change. The ground beneath your specific situation does. At this point, the pattern becomes impossible to ignore, and it leads us to the human cost, who actually gets hurt the worst and who walks away largely unscathed. Across nearly every historical economic collapse, from Argentina in 2001 to Lebanon's banking crisis beginning in 2019, to Greece's debt crisis after 2010, to Venezuela's economic implosion starting around 2014, the group that suffers most consistently is the same: the middle-class saver who did everything they were told to do. They bought a home with a mortgage. They kept savings in the local currency or local banks. They trusted that stability would continue because it always had in their lifetime. In Lebanon, starting in 2019, banks imposed informal capital controls, severely limiting how much money depositors could withdraw, even though that money technically still existed on paper. People who had spent decades saving in dollars inside Lebanese banks found that their own money was, for all practical purposes, frozen. Many Lebanese families who had planned to buy property using those savings could no longer access the funds at all. In Greece, after 2010, falling incomes and rising taxes during the debt crisis pushed average property prices down by more than 40% over several years, hitting hardest the families who had taken out mortgages during the boom years before 2008 and now faced years of austerity, meaning sharp government spending cuts and tax increases meant to repay debt. In Venezuela, hyperinflation, that at one point in 2018 was estimated by the International Monetary Fund to exceed 1,000,000% annually, destroyed the local currency. So thoroughly that many transactions, including real estate, shifted almost entirely into US dollars, leaving anyone without dollar access locked out of both selling and buying property at fair value. Pensioners and small business owners, those depending on fixed incomes or local currency revenue, were hit hardest in nearly every single one of these cases. Meanwhile, those who held foreign currency outside the collapsing banking system, who owned unleveraged property, or who had income sources tied to international markets rather than the local economy, consistently fared better. Not because they were smarter people, but because their financial structure happened to be built for a storm nobody could see coming until it arrived. The question is not whether this pattern will repeat. History has already answered that. Questioned many times over in many different countries under many different governments and ideologies. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change how you see everything that comes next. So what did the survivors actually do differently? Not as financial advice, but as historical pattern recognition, because that is the lens this channel uses to examine the past. The historical record shows that those who came through these collapses with their financial footing intact largely shared 3 characteristics. First, they avoided heavy debt denominated in a currency or system that could suddenly become unstable. Debt is a bet on the future staying predictable. And collapses are, by definition, moments when the future stops being predictable. Second, they diversified, meaning they did not put all of their savings or assets into one single basket, one single currency, or one single country's banking system. Argentine families who held some savings physically outside the banking system, even in small amounts, retained more flexibility than those who had everything locked inside frozen accounts. Third, and perhaps most overlooked, they understood the difference between owning an asset and owning liquidity, meaning the ability to quickly access usable money. Zimbabwean landowners learned this lesson in the harshest way possible. Their land was real, but it was frozen in value because nobody could buy it. The survivors were not the people who guessed the future correctly. They were the people whose situation could bend, without breaking, no matter which direction the future actually went. It is worth pausing here to mention one final older case, because it shows this pattern is not a modern invention. When the Soviet Union dissolved in December 1991, an entire system of state-owned housing and property suddenly needed new owners, almost overnight. Millions of people who had lived for decades in apartments owned by the state found themselves, through various privatization programs across the early 1990s, the legal owners of their homes for the first time. On paper, this should have been a windfall. In practice, the collapse of the ruble and the broader economy meant many of these newly private owners had no functioning market to sell into, no reliable currency to price their property in, and no banking system capable of offering mortgages to potential buyers. Real estate ownership exploded across the former Soviet states almost instantly, while the ability to actually use that ownership for income or security lagged behind by years. It is a strange historical footnote that proves the same point from a completely different angle. Ownership and value are not the same thing, and collapse is often the event that reveals just how far apart they can drift. This brings us back to that school teacher in Buenos Aires, standing outside her bank in December 2001, unable to withdraw her own savings. Over the following 2 years, the value of her trapped pesos collapsed, while her dollar mortgage became a crushing weight she had not chosen and could not escape. Argentina's economy did eventually stabilize years later, but for that family, and millions like them, the damage to their financial foundation had already been done. Real estate did not save her. It did not destroy her either. It simply reflected, with total honesty, the structure of debt and currency she had built her life upon before the crisis ever began. This is historical and educational analysis. It is not financial advice. Every individual situation is different, and every economic period carries its own unique conditions. Please consult a qualified financial professional before making any decisions about property, debt, or savings. This video is not for everyone. Most people will dismiss it as just another history lesson, something distant and disconnected from their own life. But if one person you know needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more deep dives into the pattern's history. It keeps trying to teach us, and I will see you in the next one.